Welcome to our weekly show focusing on the key macro trends affecting FX and the broader markets. This week, we'll be looking at longer-dated yields which are marching to their own tune. Could higher yields break a market which is starting to look considerably more vulnerable than it was a couple of weeks ago? Yields on the US 30-year Treasury have been moving higher. Now, this would be relatively normal if the yields were rising to a backdrop of rising interest rates and rising inflation. But both Fed funds and CPI have been trending lower for the last few months, whilst long-dated yields have been rising. And as discussed before, it looks like long-dated yields are concerned about too much stimulus juicing the economy, the impact this could have on the ability of policymakers to tackle future inflation, and the ability to pay interest on the growing stock of outstanding government debt. And the widening gap between short and long-dated bond yields does matter. That's because historically we've seen recessions occur when the spread between shorter-dated and longer-dated yields starts to accelerate higher. And this was a feature of the last 4 recessions. And today the 30-year minus 3-month spread is starting to move again. But fortunately, these things tend to play out over months rather than weeks. So this doesn't mean investors need to reach for the hard hats just yet. But we should be aware that the S&P is also testing the trend support and carving out a similar pattern to the one that preceded the tariff tantrum of last year. And tariffs, as we all know, are once again back in the news today. We've also seen demand for S&P volatility in recent days that has resulted in volatility outperforming the small decline in the S&P. So clearly some investors are beginning to worry. But instead of buying market insurance, some investors have instead been building positions in the energy sector as a potential inflation hedge. The XLE ETF has been consolidating for over a year. And many investors believe that the energy sector will eventually follow the mining sector in emphatically breaking higher. And with that, now let's look at some of the questions we've been getting from our audience. So first up, is the bond market volatility index also showing signs of caution? Well, in one of our earlier episodes, we looked at the bond volatility index, called the MOVE index. Below 100 was generally the all clear, and above 100 was often cause for concern. But today, not only is the MOVE index currently below 100, but it's still in a downtrend. And therefore, despite the rise in long-dated yields, the bond market is not really currently flagging any structural concerns for the broad-based market. And the debt burden has been a long-term feature of the US market, and that's not going to change overnight. And the next question is, why are stocks in the small and mid-cap arena starting to gain traction? Well, large caps represented by the SPDR ETF have generally outperformed their smaller cap counterparts, such as the Russell 2000 ETF or the IWM, over almost all timeframes. Investors, however, are now increasingly showing interest in small and mid-cap stocks due to their potential for higher growth, better relative valuations, and direct exposure to a resilient US economy, especially as large-cap tech dominance starts to shift, creating opportunities for outperformance in other segments of the market. While large caps have dominated, small and mid-caps offer a chance for active managers to find undervalued gems with less analyst coverage that benefits from a domestic focus and potential for policy tailwinds. And now our final question is, will a new round of tariffs have a negative impact on the market? Well, the US equity market saw a significant pullback in March and April last year when it was trying to digest tariffs for the first time. And that's the key today, because we have already seen the blueprint. And although volatility has picked up, there is limited tolerance for a significant impact to risk assets. And furthermore, last year was an attempt to reset the system, whereas this year tariffs are a specific bargaining chip. And it's unlikely that policymakers will allow significant damage to the domestic equity market whilst trying to manage international negotiations. Therefore, the greater medium-term risks are those high yields we discussed earlier, and a potential for rotation out of the market leaders and into the laggards, even if the current headlines are driving short-term sentiment. Okay, that's it for this week, but before I close, please remember that none of this is investment advice. It's for education and engagement purposes only, to help you with your own research. And remember, when investing, understand your own risk tolerance, time horizon, and investment objectives, and then invest accordingly.